Let's talk more about the markets with investors particularly focused on tomorrow's CPI data and producer prices on Thursday. Joining us is JPMorgan Asset Management's Karen Ward. Love this, Karen. You were the chair of the Council of Economic Advisors for the Exchequer, for the Chancellor of the Exchequer. That's great.
So we are still an advisor to the new Chancellor.
It's fantastic.
That's my little side hustle.
And we're going to talk global because at JPMorgan, it's really Europe, the Middle East, and Africa that you're in charge of. But I'm sure you've got thoughts about the global economy and everything that's happening domestically as well.
Absolutely.
So the Fed at this point, you're worried because inflation is sticky, 2% still a long way off, and the consumer's strong. Sounds like a great combination, unless you're trying to make money in the stock market, I guess.
Well, I think inflation is absolutely critical because it provides the degrees of freedom that the Fed have. So this print that we're going to get tomorrow is going to cause market volatility in one direction or another. We just don't know which yet. If inflation really starts to ease, and particularly that shelter component, which everyone is looking to drive CPI back down, if that really starts to ease off, then the market's going to interpret that as the Fed can reprioritize its attention on growth. And whatever happens with regards to the banking spillovers, then the Fed is there. The Fed can support. If that inflation number is sticky and core services and this domestically generated inflation still coming from the labor market, if that's still persistent, the Fed is much more hamstrung. And then we're in a difficult scenario because it can't react to some of that news perhaps quite as quickly as it otherwise might. So it's a really important release.
It was an interesting Friday with that jobs number because it ended up, I mean, it was a pretty strong number, although there were revisions, but we had a big gain in the markets. But don't you think we were looking forward to a jobs number and the inflation numbers to try to gauge what the Fed was going to do? This is a much more important number tomorrow.
I mean, ultimately, the market loves Goldilocks, right? We're desperate for Goldilocks to come back and demonstrate that we can have really strong growth with very low inflation. So that print on Friday was just on the right side of not being too hot. The economy's still producing jobs. Wage growth, there are some signs that the heat is coming out of that. So it was just about okay. But I think the jury is still very much out on quite how quickly those inflationary pressures are going to ease here in the US. And more, it's looking more difficult, more persistent over in Europe.
We took it for granted, Goldilocks. And the opposite of Goldilocks is stagflation. High inflation and low growth. That's like the worst.
Yeah, I mean, I don't think we're going to stick with that. And I actually think moderately higher persistent inflation is also good for investors.
3%. I'll settle
Sweet
for 3.
Spot, 100%. I mean, look at Europe last decade. We had one of the lowest inflation regions. That was not a sign of economic health. That was a sign of ill health, very poor corporate earnings. It's no pricing power. So coming back to a world where inflation's a little bit higher, that's better nominal growth, that's better corporate earnings. It's good for investors, and it's also good for investors in multi-asset, because we're going to get better returns on a consistent basis for income and up bonds. So I often hear clients will say to me, well, hang on, don't we need zero inflation and zero interest rates to be optimistic about markets? And I just think that's not right. It's really good, zero inflation, zero interest rates for mega cap growth. So if you want mega cap growth to be the big performers again for the next cycle, we need to go back there. But actually, if we settle into something that's a bit healthier, higher inflation, we're going to get broader performance. So for me, one of the key things I'm trying to get across to clients and investors is don't use the last cycle as your template. We're in a different world. The combination of the pandemic and the energy crisis has switched us out of that austerity-driven weakness. And we need to think about changing performance on that basis.